Hi, everybody. Thank you for joining our live show called How to Beat the IRS Legally. My name is Borbala Banto, CPA, founder and president of Concierge CPAs. And here in the office with me is my brother and associate Laszlo Silagi, who is at the control board. Good to see all of you. Today, we have two very important topics. I wanted to point out that you can put your questions in the box on the chat box on the left. We make sure that Laszlo is going to answer the questions that go in the chat box. And also, please note my phone number and email address. Laszlo is going to put those in the chat box as well. If you have any questions during or after the show, please feel free to send us an email or call us directly. So let's dive in. Our first important topic is hiring your kids or grandkids for that matter. How can that lower your taxes? If the IRS would say, I will give you $2,458 if you give your child $6,100, then would you be interested in that proposition? I think most of us would. And that's what the federal and the state government paid Jennifer Myers when she paid her daughter $6,100 to work in her self-employed business. I wanted to get a picture of Jennifer Myers, a lady with a 13-year-old child, but I couldn't find one. So last night I put my son on the picture with his scout leader. My son's name is Christopher, and he's not 13 yet. He cannot work. He is just 5 years old. And but we can picture Jennifer Myers with her kid that she hired. How did she get a $2,458 tax break from that? The $2,641 that Mrs. Myers received from hiring your child was in tax breaks, and we're going to explain that in a second. First, let's examine the situation of Mrs. Myers' child. The child pays 0 federal taxes on the $6,100. And this is earned income, right? So nice, 0 tax, 0 Social Security, and 0 income taxes. Mrs. Myers received a tax deduction for the $6,100 that she paid her child. So she didn't pay the taxes on this amount either. So what makes the child's taxes 0? I think we all know it's the standard deduction. This is the deduction in lieu of itemizing your deductions for mortgage interest, for property taxes, for charitable contributions. This deduction was $6,100 for 2013. It's going to be $6,200 in 2014. So why would somebody hire the child? I think we can see it on the screen right now. We go back one slide. Jennifer Myers would have paid $933 in self-employment tax on this amount. That's the 15.3%, Social Security and Medicare. And she would have paid $1,525 in federal income tax. And some in Ohio, we would have paid Social Security or state taxes as well, 3%. So that's a total of $2,641. That nobody had to pay because the child was hired and the child didn't owe any taxes on this amount. So why hire your child? First of all, hiring your child gives you the opportunity to work with someone you know, love, and trust. So that's an added bonus. If you give money to your child or plan to help the child pay for college, the hire your child strategy is a big assistance. First, you get a tax deduction for the wages instead of just giving your child the money that you already pay tax on. Second, your child can put earned income into an IRA, Roth IRA or traditional IRA. That money grows tax-free in the retirement account. But here is the loophole. If the child wants to use the money for college, she can use it and she can actually break the IRA and take the money. There are 5 exceptions of when you can take money out of the IRA penalty-free, one being higher education or paying for a first home or serious medical expenses. So this is a huge break. So the child earns, let's say, not 6,100, but what if we want to pay our child 11,200? And I'm putting this amount there because that is an amount, an extra amount that still doesn't owe any tax. Nobody owes any tax on it. So let's say Mrs. Myers paid her child 11,200 and still wants to pay zero tax. Is this possible? Yes. And this is how it can be possible. If the child puts $5,000 into an IRA, and it has to be a traditional IRA, gets a tax deduction for this $5,000. And then we have 6,200 left, which is the standard deduction. So the computation eliminates 5,000. We are left with 6,200. That's the standard deduction. Nobody pays any taxes, any income taxes. So how does this really work as for a sole proprietor? I think most of us on the call are sole proprietors, are either in a virtual franchise or in some type of one single member LLC or one owner self-employed business. So here's the big picture of Mrs. Myers as a self-employed business person. This is what she has to do legally to do this. She writes payroll checks to the child, and the child is less than 18 years old. The checks total up to 11,200, so she actually has to pay the cash. So the child has the cash now. The child puts $5,000 in the traditional IRA. The child doesn't have to pay any self-employed taxes, 15.3, nor income tax, which would have been 25% for the mother. So she paid $4,513 in taxes. But you can ask, what happened to the payroll taxes? Here's the thing. Payment for the services of a child under the age of 18 who works for his or her parent in a trade or business are not subject to Social Security and Medicare taxes. If this trade or business is a sole proprietorship and every partner is a parent of the child. So basically the business has to be owned either by the mother or the father or by the parents jointly. You don't owe any Social Security or Medicare tax on the child's income. The parental proprietorship and partnership hiring rules also exempt the wages paid to the child of unemployment taxes, federal unemployment taxes. Until the child reaches 21 years of age, you don't owe any federal unemployment taxes on the child's income either. So somebody might ask, what about the kiddie tax? We all hear about this kiddie tax rule. Kiddie tax rules only apply to unearned income, like dividends and interest, and not earned income, like a W-2. So while the law says that if their child earns interest and dividends, investment income, they have to pay the same effective tax rate on this income as the parent's tax rate. So if there is a millionaire, he or she cannot put half of his brokerage account under the child's name and the child earning the interest and dividends, because the child will pay the same interest rate or tax rate. But if the child earns the money, effectively working, they have their own tax rate. So how young can a child really be? The law doesn't list any minimum age, but we have court cases that list age 7 as really the minimum, the youngest that's seen. And we have a case called the Eller case, where Mr. and Mrs. Eller owned and operated a mobile home park, and actually a couple of them, and they hired their children who were 7, 11, and 12 years old. And the IRS said, no, this was not really a real work that the kids could be paid for. And they went to court, and actually the court agreed with the taxpayers. So then the IRS had to agree. So they said in a letter that compensation is deductible only if it is a reasonable amount, it was actually paid, and based on the services actually rendered. The fact that payments are made to minor children by their parents does not preclude deducting the payment. So for us, this means that we need proof that the amount that we are paying to our children is a reasonable amount for the services actually rendered, and actually we have to prove that we did pay them. So it's very important to keep great records, and we're going to talk about that in a second. So what about child labor laws if a child as young as 7 can work? Parents employing their children are mostly exempt from the labor laws. The Fair Labor Standards Act provides that youth younger than 16 of age working in a business solely owned by the parents or by persons standing in place of their parents can indeed work any time of day for any numbers of hours. So this is totally different than the child working in the McDonald's, right? However, parents are prohibited from employing their children in manufacturing or mining occupations and anything that is declared hazardous activity. So, of course, we all know that. So, as I mentioned, there is an extra scrutiny from the IRS when you hire your children. So there are a couple of things that we should bear in mind if we utilize this. The court notes that the wage and salary payments from the father or mother to one or more of the children require careful scrutiny. It's a family relationship. The court needs to take a close look to make sure that it is both a bona fide employer-employee relationship next to the family relationship, and also what was the performance of the services for the business. So let's see, what can we do to audit-proof our return if we do indeed hire our children as young as 7 years old? What kind of audit-proof system we can have in place to stand in an audit? So I have 5 major things that I listed. First one is get an employer ID. When you become an employer, then you need an employer ID. And you can apply and get one even if you don't have an LLC. Or if you do have an LLC, it doesn't matter. And you can apply online or by the telephone. I would suggest that you go to IRS.com and search for EIN on the search bar on the top right corner. Or you can call the phone number on the 800-826-0493. So most people would do this online, and actually you get the ID number right at the end of the wizard in a PDF. So you get an employer ID. And then you have to have a timesheet. A handwritten timesheet is an excellent proof. Your child should complete the timesheet daily and return it to you weekly. Actually, we do have a sample timesheet that you can use, and we're going to put it out there in under the chat, so you can download it. It's very simple. So you can get this at the end of the presentation, as I said, and you should give it to your child to complete it if you hire your kids. And actually, there is a case that I just read about, the Vernon Martins, who hired his 2 sons and lost about 80% of his deductions for hiring her children because they did not fill out required timesheets. So the court agreed with the taxpayers that yes, indeed, they did work, but because there was no timesheet, no handwritten proof, they took 20% of the deductions away from her. So document the pay scale. That would be number 3. If you're paying your child a minimum wage, you don't have to worry about documentation of the pay rate, right? But you probably want to pay at a higher rate. This requires proof that the rate that you're paying is a reasonable rate for this type of employment. So let's say you used to pay a web developer $75 an hour to set up your web pages. Let's say your son can do this work, but he's going to do it slower. So it takes him about twice as long as it would take a real developer. So if you have to think that an hourly rate, let's say $37 or lower, it would be reasonable for your son, right? The key here is documentation of how you arrived at the reasonable rate of pay. Number 4, pay with a check. Always pay wages by check. You need to establish a clear audit trail from your business checkbook to your child's checkbook. So remember, when you pay your child, this is your child's money. And actually, you cannot use or ask your child to give it back to you for the obligation, parental obligation. But summer camp, a Nintendo fund, a pizza is not parental obligation. So actually, you can ask your child to pay for his own camp, his own private school, parochial school, or any type of extracurricular activities. That is not your obligation, so they can totally use that. But as far as food and shelter, you have to provide that as a parent. So number 5, complete the federal and state payroll forms. And there are about 5 forms that you can find on the IRS's website. It would be W4, for example, and then W2, 941, and 940. And you will, when you get the transcript of this call, then you will, we're going to list that in there, all of them. Basically, the W4, everybody knows, that's the form that your employee, your child, uses to tell you, the employer parent, how many exemptions and allowances he or she claims, or whether he or she is exempt from withholding taxes. And probably that's going to be the case, right? There is no withholding that needs to take place if you pay your child $5,000 or even up to $11,000, $1,200, we said, a year. The W-4 you have to fill out if you pay your child more than $600 in wages. You must provide this to your child at year end. And there's a W-3 form and copies of the W-2 that has to go to the Social Security Administration. You can get these forms actually for free if you call the IRS or you order them online. It takes them about 2-3 months to send it out. So actually, we tried that out this last year in our office, and we ordered them in October, and we got the free forms from the IRS that we still see people using, the handwritten forms. So you can totally do that. Or you can go to OfficeMax and get some forms or software, but they might cost you that might cost you more money. Here's one thing: after you become an employer per se, you need to file Form 941's quarterly forms with the IRS, even if you don't have wages. Couple of quarters, you still have to file 0. So we said there are no payroll taxes, and there's not going to be any payroll tax that you have to attach to any of these forms, but you do have to send them in. So here comes the perennial question: does the parent really want to have all this compliance and do all these filings in order to save money? And in some cases, unfortunately, the answer is no. Instead of saving for $4,500 or $5,000, they say, it's not worth for me. But here's the thing: if you think about it, with your couple of hours of your time every quarter or year end, you can save a lot of money. You can save $5,000 every year if you do this. So you have to file Form 941 and 940. 940 is the federal unemployment form. Once a year. Again, you're not going to know anything, but you have to fill it out. You have to put 0 on it and send it in. So if you have any questions regarding what forms you have to file, again, just look at the transcript of this call, and also you can send us an email or call us, and we are going to list it for you. What should you do with the money that your child earns? The best thing to do is to put it somewhere where it grows, right? So now you pay the child wages. Child has great opportunities. As we said, $5,000 to put in a retirement account. There is this calculation that if your child works 12 years in your unincorporated business from the age of let's say 7 to age 19, when he or she goes to college. And they earn $5,000 a year, and they're going to put that $5,000 into an IRA. And even with a conservative, let's say 10% annual return, you know how much the child would have when she turns 19 years old and goes to college? $117,614. This calculation with a 15% annual return is about $170,000. So just imagine having a 19-year-old starting college and have this amount in their college fund, basically retirement account, which we said they can use for college. So it's a great opportunity. If we would be consistent and doing this year by year, it would be great. Of course, to start with, we would save a lot of tax money during those 12 years. So that's one savings. And then the interest and dividends is great. So what can we say in a summary about this topic? When you hire your children in your home business, you need to follow some compliance. Some would say a lot of compliance, but you can save several thousands of dollars every year. So if you plan on hiring your children, think young and think annually. Of course, and I got this question a lot. What if I just started out my home-based business? I'm self-employed, but I just started out. What are my options? I didn't even earn $5,000 and I still have expenses. So can I hire my children? So basically, a lot of times I say you can save money when there is income. So you have to have income in order to save money. So I see so many even distributors or sole proprietors who earn $20, $30, $40, $50,000 in their Schedule C unincorporated little home business. And so if they can find legitimate work to give to the kids and they document it, and it's a great opportunity, not just for tax savings, but to have money set aside in IRAs and for the kids, and also to teach the child what is work, what the parents do for the money, and that's a great experience. So if you have any questions regarding this topic, then please, I see a great number of posts in the chat boxes. So we make sure to answer all of them. If by any chance we would miss some of them, please shoot us an email at borbala@conciergecpas.com, and Les is going to put that email address into the chat box as well, so you have my email address for sure. So let's see the second topic. And I will take over of the slides just so Les can answer the questions. Okay, we'll see how it goes. So what is our second topic, big topic that in every presentation that we make comes up is, what is this MERP? Why I haven't heard about it? What is it? Who can use it? Why I haven't heard about it? And actually, the thing is, the MERP or Section 105 plan has been around since the 50s. So it's more than 60 years old. It's not something that's new in the last couple of years. It is a very, very old tool. And I don't understand why more CPAs or accountants not suggest it to their home business clients, because it's a great tool. So let's go through it and spend a few minutes on really seeing what this is and how it works. So, as I said, the Section 105 plan is a health reimbursement account. So some call it Section 105 HRA, health reimbursement account. And it creates outstanding benefits for certain one-owner businesses. So let's review these businesses. Section 105 plan turns your medical deductions into business deductions. When I talked about the MERP the last time, I got so many questions saying, oh, my CPA told me, or tax advisor told me that I cannot deduct medical expenses. And actually, this is a quote from somebody I just talked to last week. I cannot deduct any medical expenses because I don't own my home. And for a second, I was thinking, what? Then I realized what the tax advisor wanted to say. They meant that your itemized deductions are too low for you to itemize, and it's better for you to go with the standard deduction. So going back one step, we know that the law says if you are, let's say you are married filing jointly, the first $13,000 of your earned wages, you are not paying tax on it. You're not paying any income tax. That's what we call a standard deduction. The law gives you a standard deduction, so $13,000 is deducted from your income, so you pay income tax on the rest. Or we have this interesting thing here in the U.S. called itemized deduction. The law also says that, you know what, I will give you 5 categories of expenses. If you do have expenses in these categories, then I'm going to let you use the total of your expenses in these categories in lieu of instead of using the standard. So what are these categories? First being medical deductions, then home mortgage interest, property taxes, the state and local taxes that we pay on our W-2s or otherwise. Charitable donations is a huge amount. And so if somebody who owns their home and they have, let's say, if somebody pays $1,000 mortgage a month, probably about $800 is interest. So they already have, let's say, $9,600 in this itemized category. I just talked to somebody, a new client, when I looked at their last year's tax return, they donated to charities $28,000. So clearly, if this couple has $28,000 charitable deductions, they're over the standard limit. So it's in their benefits to itemize. So what about the medical? If we can put the medical out-of-pocket medical expenses, but the law says only the amount that is above, it used to be 7.5, now 10% of your earnings, of your adjusted gross income that you can put in this file, this itemized file. So what does that mean? If we have a taxpayer who earns $100,000 and they have $5,000 unreimbursed co-payments and prescriptions, unreimbursed medical expenses, would they be able to put anything on the itemized expense file? No, because the law says only whatever is above 10% of your adjusted gross income can go in this file. So if a couple has $15,000 of unreimbursed medical expenses a year and their income is $100,000, how much can they put in this file? $5,000. 10% of their adjusted gross income is $10,000. So if they have $15K expense, $5,000 goes into this file. I can tell you 99.9% of my clients are not on this list. And unless something major is going on, they cannot claim any out-of-pocket medical expenses on their tax return. It's just, they don't make the ceiling. So when clients came to me and said, oh, you talked about the MERP, but my tax advisor said I cannot use it, immediately I got, oh, this is different. We are talking about medical expenses being on the business side and basically being just a deduction on the business tax return, or if you have a Schedule C, a business page of your tax return, next to office expense, next to mileage, next to dues and membership, next to travel and meals and entertainment. So let's see, how can we make these medical expenses that a family has that insurance doesn't cover, their co-payments, prescriptions, all kinds of things, and we're going to go through the list. How can we make these into business deductions? That's why if you see the catchphrase, how can you make your daughter's braces into a business deduction? That's what we mean. So we said the biggest benefit, basically the only benefit, is that we make these expenses that we already have. We have these. Doesn't matter if you have a business or not, how much medical expense you had, you have it, right? So we said this is superior to the personal medical deductions, and I will show you why. The first one would be, if you earn money, profit in your home business, what type of taxes you pay on it? First of all, you pay Social Security and Medicare, which we call self-employed taxes. How much is that? 15.3%. So if you earned $1,000 profit, $153 goes into Social Security and Medicare. Then how much is the income tax? Again, whatever is your tax rate. Maybe it's 25%. Then $250 goes to the Treasury. So that's 40% of your profit goes to taxes. What if you have an extra deduction in the form of these medical expenses? Then you're not paying Social Security, Medicare, and income tax on this amount. So clearly, you save 40% on them. Let's say Sarah has a virtual franchise and she's a Juice Plus distributor, and her husband Sam works for a large corporation, and the large corporation pays for the family's health insurance, but they still have copays and prescriptions and other deductibles. So if they don't have any Section 105 or MERP, as we said, if they have $5,000 in medical expenses, they're not going to be able to deduct it on the itemized list. Their income is probably too high. 10% of their income, that's the ceiling, it's too high. They're not going to be able to deduct it. If they have a Section 105 plan, then this $5,000 or $6,000 medical expense becomes a business deduction. And who has the business? Sarah has the business. So she is not paying Social Security and Medicare, that's $918, and income tax, which would be about $1,500 for her. So how much is she saving? Let's say on a $6,000 medical expense for the year, she's saving more than $2,400. So the question is it really worth for Sarah to look into this for a $2,400 savings? I think I read a statistics that the average amount of tax that the Section 105 owners save is about $2,500. So let's see, if we have an employee benefit plan, what does that entail? How does it look like? So we said this is an employee plan. So we have to have an employee, right? Somebody needs to qualify to be an employee of your virtual franchise or of your home business. So the problem is if you have a larger business that has employees, right, then the law says you cannot be your own employee if you are just self-employed, so you are not considered. So you cannot get benefits. So that's why the question is there somebody else in your family that you can hire? Is it your spouse that you can hire to help you in the business? Or is some of the kids that you can hire? I just talked to somebody who said, you know what, my spouse really, I cannot employ my spouse. He has such a job, like some military stuff that he cannot be employed, even part-time, of course, in my little business. But here was the situation. One of the kids in the family had this huge out-of-pocket medical expense every year. So I asked the mom, is the kid somebody you could employ and she would be able to do work for you? So then she would become an employee and her medical expenses would be covered. And so that was a question that she had to ponder upon. So if you are married, you can hire your spouse, as you said, or your kids. What if you're not married? If you're not married and you do have enough medical expenses that warrant this plan, then you could organize your business differently. And without going into it, I just wanted to mention number 3 and 4 here, S corporation and C corporation. S corporation, it's not really a lot that you could do, but if you are not married, you could ask the IRS to tax you as a C corporation and hire yourself. And I do have clients who have the Section 105 plan with a C corporation. Again, as always, if you do have a good tax advisor, tax coach, then you can run numbers and projections of really how different taxation affects your profit from the business. Or, is it worth having a Section 105 plan? Is it worth being taxed differently? So we said you would be able to hire somebody else than your spouse. What if one of your parents can do work for you and is really has a lot of medical expenses, and you can give them a job that would qualify them being your part-time employee, and then you would be able to pay them in form of benefits, reimbursing them for these expenses. So just be creative and think big picture, not just a spouse. So like, for example, retired parents, like it could totally be one of these plans. So what is the fine print? How does this really look like? Just when you were employed, maybe at a big corporation, and then whatever insurance the corporation offered, everybody, had to be in it, or they could opt out. It works similarly. If you have more than one employee, you have to extend this plan to all of them. So you can't just cover yourself and your family and exclude everyone else. But here's the thing, there are safe harbors that you can limit coverage. So specifically, if you have somebody who works for you who is under age 25, works only part-time, has worked less than nine months, a year, or less than 3 years in total, you can exclude them. So I do have clients who said, you know what, at least we just started the business, and then we are gonna wait and not cover our employees in the next 3 years. So in most cases, a small Schedule C, basically no other employees. So this is perfect for just one spouse who has a business and can hire the other spouse or any of the children or any family members. So what is the benefit? Once you qualify, the law says, and the plan agreement says, that the business can reimburse the employee for all medical expenses that they incur, and not just themselves, but their whole family. So where does this put you? You are covered under your spouse. So you cannot be your own employee, but you can have your spouse employed, and through the spouse, this would affect you and all your kids as well. So if you are married and you hire your spouse, then you can reimburse the spouse and all your kids. So you just converted all these expenses that you cannot use anywhere, but they're legitimate expenses. You have to, get your medicine from CVS anyways, but you are able to deduct them now on the business tax return. So you're saving 15.3%, as we mentioned, and also if your income from the business is high, there is a new tax out there called the 2.9% extra Medicare tax. So you can actually you can save a lot of money. So what are the eligible expenses? Really, let's just touch on them. What exactly can you deduct? And the answer to that is pretty much everything you can think of. Includes all the things listed here on the screen: major medical insurance, long-term care coverage, Medicare Part B and D, Medigap, co-payments, deductibles, prescriptions, dental, vision, chiropractic care, LASIK, big ticket items like we mentioned orthodontics, fertility treatments, eye surgery, and also special schools for disabled children. And I do have clients who get prescriptions even for not over-the-counter medicine like Tylenol and Motrin, and then they become deductible as well. And also if you get prescriptions for any vitamins or massage therapy, special beds, special trainer, like if you need swim therapy and stuff like that, it's all deductible. So just make sure that you do have a prescription or doctor's note, or you pay basically the lab or the doctor or the hospital. So what paperwork should you really keep? First of all, you need to have a written plan document, and that's something that we can provide you. It's basically a legal form that you print out on the business letterhead saying, this is the plan of whatever business. And even if you don't have an LLC and your business doesn't per se have a name, that you can use your own name, and this is the legal document of the business. So you sign it, you date it, maybe you can even witness it, and just keep it in the drawers with your tax files. So one thing to mention, all the benefits that you're paying your spouse, so basically your spouse is not getting a W-2, unlike what we just talked about with the kids. In this case, the law document says that your spouse is getting reasonable compensation in the form of these reimbursements. So you don't have to worry about Social Security and Medicare and any payroll tax filing. And that's why this MERP, Section 105 plan, is so much better than when you have to hire your kids, or if you would really have to hire your husband for cash compensation. So one thing to think about, if just the teenager stuffs some envelopes once a year for you, then the IRS will have a hard time believing that the set of braces is a reasonable compensation for that little work. So you will need to verify that the work that your employee does in order to establish the benefits that you are paying are reasonable compensation. And that can be a hot button. Finally, you need to establish paper trail. This means tracking expenses, of course, but also reimbursing your employee out of the business account. So just think about when you work somewhere else and you submit a reimbursement form, how does that look like? So basically, as when did the expense occur? Let's say the medical expense. I paid Cleveland Clinic on January 31st, and it was, how much was the amount? $200. So if I total my expenses up every month and print it out, give it to the business owner, which is, of course, my spouse can reimburse me and write me a check out of the business checking account. What do I do with this check? I deposit it in my personal account, because, of course, I do have a separate business account, right? Everybody should have that. When you have a Schedule C, even a home business, you should have a separate checking account. So it's not just enough to pay for these medical expenses out of the personal checking account originally, and then put it on the number on the tax return. Basically, I should get a reimbursement check from the business account that I deposit back into my personal. And that will establish a link and a paper trail that this really happened. This transaction really happened. So in some of the cases when we do get like FSAs, big corporations, we need an outside third-party administrator for this. In this case, because it's just family, and so we know what kind of medical expenses we have, there's no need for an outside third-party administrator. However, the IRS rules that the employees cannot really self-certify their expenses, so that's why we need the reimbursement form. We need to list them. And this can be in any form. It can be handwritten, can be in Word, in Excel. Just make sure that you list all the expenses. So I have clients who, whenever they go to CVS or they get their credit card statements, they go through them and they just get out every $5 co-payments to their prescriptions. They look through their checkbook manual monthly, seeing what type of medical-related checks or bills they paid, checks they paid. So there's no special reporting required. The interesting thing is nothing goes to the IRS or anywhere. So all this record keeping, it basically stays within the company. Then at year end, when you do your tax returns, there's a line on the business schedule. Schedule C says employee benefits. That's where you would put the total amount of these reimbursements. I'm sure a lot of you remember the HSAs or know how those work. And you have to tell the employer how much you're going to put in this special account, and it has to be a separate bank account if you're self-employed. The great thing about the MERP is that no pre-funding required. You don't have a lose it or lose it rule. You don't need a special bank account like in the savings account case or the flex spending cases. You don't have to decide ahead of time how much you're going to put in this in this reimbursement account. Really, the plan is just an accounting device that lets you characterize your family medical expenses into business expenses, of course, if you do all these compliance things that we just talked about. So there's a new rule as of last year that all Section 105 plans have to send in IRS form once a year, and the form called Form 720. You can Google it or find it on the IRS website, and it's it ties to the new Obamacare rules. It's called the Patient-Centered Outcomes Research Institute fee, and there is a $2 per participant that you have to send in. This is due July 31st. Last year it was $1 per participant per plan. So last year a lot of people filed this form with $1, and this year it goes up to $2. So if you have a plan or you're thinking about putting one in place, just make sure that you Google Form 720 and fill it out and send it in by July 31st with $2. Ordinarily, the form says that this is filed quarterly, but if an employer owes no other excise taxes, they might file annually. So that's why I said that the due date is July 31st. So let's summarize of how do we put this in place. First of all, we create a plan document, sign it, and keep it in our tax file. And remember, if you're going to sign it now, every expense, medical expense that your spouse employee has after you sign the document counts. So you cannot just show up really December 31st and say, oh, I forgot to put this in place. What are my total expenses, medical expenses? Let's total them up for this previous year. The form, as I said, doesn't have to be sent anywhere, doesn't have to be notarized, but, if you would be asked about it, it's under oath, so, it's your choice. But basically, you sign it and keep it in your tax files. So if you operate as a staff-employed individual, which most of you are, then you need to hire a spouse and have a plan that covers both you and him and the kids. Make sure that you have proof that the spouse does actually do the work. Simple and easy way to get proof, again, just as with the hire your kids idea, you have to have a timesheet that your spouse puts in how many hours did they work and what is the description of the task that was performed. I know a lot of distributors whose spouse is actively advertising the business and goes with them to all the functions and helps with the setups of the home parties or other things. So and actually some of them they earn a 1099 from a distributor company. Question is, and I get this a lot, should we have a formal employment agreement for our spouse? And the answer to that is that based on the court cases, and most of the tax coaches say that please don't, because people get this wrong all the time. Whatever you put in there in an agreement that would say, oh, my spouse is going to work 10 hours every week or 5 hours every week, the likelihood of that not happening really that way is very, very high. So employment contract doesn't prove anything anyway to the IRS, doesn't prove that they actually did it. So it's better if you don't have one, just have very good timesheets. So let's summarize the reimbursement. Get the checking accounts and the reimbursements right by business, having a separate checking account, right? Employee spouse should have a separate personal checking account that's not together, with the business. So you pay, or he pays, all their medical expenses out of the personal account, and then once a month or once a quarter, they total all those expenses up and you write them a reimbursement check. I have clients who use a credit card to pay, like a business credit card, to pay all the medical expenses, and the spouse has one. So in that case, the business pays for the medical expenses outright, then no reimbursement is necessary. So if you want to keep track of that, then you can do that. But most of the time we use a personal credit card or paying for our medical expenses from our personal checking accounts. So in conclusion, if you fit the profile for a Section 105 plan, then you can sit back, relax and smile, and knowing that your created deductions, tax deductions, where none existed before. So if you fit the profile, question is, maybe you don't fit the profile this year, maybe you're going to fit the profile next year. Again, just with the hire your kids idea, I get that question a lot. How can I hire my spouse if I don't earn enough money? Again, if you're just starting out and you don't earn enough money, then you cannot hire your spouse. But if you have $20,000, $30,000, $40,000 in 1099 from any type of self-employed business, then you do have enough maybe to reimburse your spouse for a $5,000 medical expense, right? And the spouse doesn't necessarily just have to do what you do. Like, they can do the website, IT, phone, they can be consultant to you. So they just be creative in what type of work does my husband do for me? What is his role in my business? What do we talk about how does he help me with the business when we are together? So I see a good number of questions about this. And before we finish today, I wanted to put up on the screen 3 options for you that we got requests from so many of you. So these options, one is, people were asking me after the presentation that how much is for your help if I come into your office and I want you to go through my case and really see if I qualify. Look at my business profile. Do I qualify? Do I not? What's going on? Then I told them our fees for that consultation, all together with giving you the plan document, sample timesheets, look at your reimbursement sheet, and guide you how to put this together and look over it, that would be $500. And then I realized that some of you might not need that much personal interaction in the implementation of this plan. And we got this question like, how can I buy this plan for you? I want to make sure that I have, because this is a legal document of the business. Do I have a plan that I want to have a plan that is legal and I can sleep, well, and I don't have to be afraid of the IRS if I have it. So we came up with 2 more options of us supporting you in getting a MERP. And the second one would be if we give you the written Section 105 or MERP document and give you a sample timesheet for your spouse to use, and of course the transcripts of this webinar for you to read, and also to replay the webinar if you want to go back and re-listen to it. And also, we can support you over the phone up to 1 hour. And this can be 4 or 5 different calls, up to 1 hour total. And that would be a $247 help. So if you're interested in this, until this midnight, you can go on this website, and I make sure that Les puts it on the chat box as well. You can go to conciergecpas.com/MERP, and there are 2 buttons there. And this is for option number 2. And you would pay with your credit card or debit card or PayPal. And right after going through the giving us your information, you would get an email with all this information: the written Section 105 plan document, timesheet, and the transcript, and the video, and also a link to my online scheduling calendar that you can use every time you want to talk to me about it. So that would be the option number 2, $247. But option number 3, if you really think that you just need the plan document and you already figured out what to do, how you fit the profile based on this webinar, and of course you can get the transcript and the video replay, so you can replay it for yourself. If you just want the document, because you want to make sure that if even if not random audit, because there's such thing called random audits. 10,000 people every year, the IRS just randomly audits to see what's going on. So if you would get this, and knowing that I mentioned a couple of cases, but there are a lot of court cases. Again, I'm not saying that people who have this plan are auditing more, because that's not true at all, but if you just need the plan document, then you could just get one for $97, and that's again another button on this squeeze page at conciergecpas.com/MERP. So please let us know what questions you have. Make sure that you call us or email us. Email is tax season, so probably email works better because we might get our voicemail more because we are with clients all day. So please let us know how we can support you. And if you are ready to be proactive, to do all this compliance stuff, to save a lot on taxes, then congratulations. You are on the right track. You are on that couple of percentage of the taxpayers who are really proactive. And you know what? Somebody just told me $5,000. In that case, it was a $5,000 savings between hiring the kid and implementing the MERP. She said, you know what? That's 1 week of all-inclusive vacation in Mexico that I can take my 2 kids on. And just imagine your spouse, like, telling your spouse, hey, we're going to save $5,000 this year on taxes, and we can get this money and go on a vacation or do whatever. I mean, that's a good down payment on a good car, or also it can be extra college savings or whatever you want to do with it. So thank you very much for your time today. Let us know how we can support you. You will get an email with the presentation and the links to the transcript and the replay of this webinar anyways. And again, thank you very much. Everybody have a great rest of the week. Stay warm in there. We are in Ohio. It's very cold and snowy out there. So talk to you soon on a different webinar. Thanks again.